Looks like we have 39 participants. That's pretty good.
Wow.
I'm going to get the meeting started. Hope everybody had a good breakout room experience. My name is Peter Goodman. I'm the New England Business Brokers Association president, and my company is Goodman and Company Business Brokers in Sudbury, Massachusetts. Anyway, today we have another in a series of 12 monthly meetings we're providing to our membership. And for the first month in a while, we have not had new members. So why not? Kind of stresses me out a little bit, but overall membership numbers are doing well. So it's not an issue for us. Okay. I just want to remind everyone of all the great NEBBA member benefits, including the NEBBA Google group. You're known to your peers as a member in good standing of NEBBA. It's good to display that logo on your website and in your credentials. And also want to remind you that we're always looking for new presentation ideas. So if you've got something for us, please send me an email or anyone on the board. But it's mostly me and Jennifer Fox that plan this stuff right now anyway. And hear what you have to say. Okay, and I just want to quickly mention the website sponsors who are Merrimack Business Appraisers, Lou Perez, who will be speaking to us shortly. Atlantic Capital, which is Beth Che, who's Vice President of SBA Lending at Atlantic Capital Bank, TD Bank, and Jennifer McKay is the Vice President of Business Development Officer in the SBA Division. We have Eric Sigmund, who is in his new company with Roberto Israel, who will also be speaking for just a couple of minutes. He's an M&A and attorney and a NEBBA board member. We also have Steve Sanders from Wells Fargo Bank, and he is a commercial business development manager. There's also Live Oak Bank, which is Jonathan Smith. I see he's on the call. He's Vice President and Senior Loan Officer. We have Jordan Richmond of Fidelity Bank, and Jordan is a SBA Business Development Officer. And also, finally, Machinery Equipment Appraisers. That's Justin Gurley, who we heard from last month, who, by the way, I think gave an excellent presentation about equipment appraisals. I learned a lot from that. That was very useful. Okay, but quickly, I'm just going to introduce Eric Sigmund, who is a website sponsor of the New England Business Brokers Association. And Eric recently took a position at Roberto Israel and Weiner, who happened to have sold my business in 1999. I owned a computer company. Anyway, Eric focuses his corporate practice in the areas of franchise law, corporate formation, capitalization, succession planning, commercial leasing, mergers and acquisitions. His transactional practice, includes counseling clients in connection with mergers and acquisitions, asset and stock purchases, buy-sell agreements, corporate formation, partnership agreements, contract drafting and review, and other general corporate matters. Take it away, Eric.
Thanks, Peter. So I just recently joined Roberto Israel Weiner, which is a firm located in Boston. The firm focuses a lot on corporate matters, strong in M&A, tax, has a very strong hospitality restaurant group. Also starting to get into the cannabis space as well, and also has a very sophisticated real estate practice. So it really does sort of fit my practice very well. It's a very good platform. We've got a lot of resources there to handle all sorts of different matters for clients. My practice personally, as Peter sort of articulated there, really focuses on kind of two areas. One is mergers and acquisitions, and then the other one is franchise law. So I do traditional M&A work, all the way from, the Main Street type businesses all the way up to more complex deals. So, basically any size deal, it doesn't really matter to me. And then the other part of my practice is franchise law. And in that vertical, I sort of focus on representing franchisees, franchisors, mostly franchisees in sort of growth moments or transition moments in their businesses, whether that's buying franchises, selling franchises, or, with existing businesses trying to grow through franchising. So, just a couple of examples of the type of deals that we handle. I just finished a deal for a client who was buying 15 units of a pizza franchise in South Carolina. That involved a lot of sort of heavy lease negotiation type work, in addition to the traditional M&A work. Right now I have a deal going on where a client's buying 8 daycares. So that's another sort of similar type deal. But, I also have a couple other deals with single unit franchisees as well, who are acquiring, a single location or sort of starting a new franchise. And then I also have a medical supply company that I'm representing as part of a roll-up. I'm representing the seller of the company. There's 2 other companies that are being rolled up by a private equity group. So that's a slightly more sophisticated deal. So it's a pretty good range of deal types. So, I'm happy to help out and answer any questions anybody might have about, deals in general. And this is pretty much all I do is deals. So happy to help, and thanks for the opportunity, and looking forward to the meeting. So thank you.
Great, and thank you, by the way, for all your contributions to NEBBA, all the work you've done on our board. You've helped us, and the presentations you've given us have been very helpful. So thank you for all that. Okay, I just want to mention we have an upcoming meeting, which is on May 12th, and that's going to be about helping your sellers save on capital gains taxes. And that's a great thing, of course, to be able to help your seller with, and certainly to use in a listing presentation. And because that's one way you can really benefit your sellers. And obviously we want to talk about that when we're dealing with signing up new sellers. Okay. And all right, so without further ado, I'm going to just move things over to Lou Pereira. Oh, I'm sorry, one more announcement I want to make is I've started a YouTube channel for NEBBA, and I'll be sending out details on that, but it's going to have all of our videos. So I apologize. We've been pretty bad in getting these videos out there, frankly. And it's certainly partly my fault, at least. I just do so much stuff. I wish I had a volunteer that would just sort of take over videos. That would be nice. But since I don't have that at this time, I've just got to get to it. But we're recording this meeting, for example, and the way I'm doing it now, I can easily just cut out the portion that we want to share to our membership. So that will be coming up soon. All right. So anyway, so we have Lou Pereira today. And I'm going to quickly unmute Lou. Lou, wait a minute. Asked to unmute. Lou, you want to unmute? There you go. How do you want, should people interrupt during the presentation to ask questions, or should they just sort of put their questions in the chat and ask them at the end?
I guess we can do it whatever people want. It is a fairly large group, so I don't know if it's going to be more problematic to have everybody trying to speak at the same time. So
well, all right, for most people,
I can try to watch. I'm sort of paying attention to a lot of different screens here, so I'm not certain that I can watch if people raise their hand. So what I would recommend is you can hold questions to the end if you like. We'll give some time for that. As I'm going through, if you've got comments, I do want this to be somewhat interactive, and I want to hear your opinions as well. And we can go over that. So if I don't see you, because I can't see everybody on the screen at the same time anyway, if you feel you have something to say, then unmute yourself and just sort of, just like you would in a classroom, make it known that you're there. Perhaps that's the best way.
All right, good. All right, so anyway, so let me just introduce Lou, because he's a modest guy. If I don't say how great you are, who's going to do it, Lou? So Lou earned an MBA and holds CBA, ASA, CBI, and CVA credentials. He's the president of Merrimack Business Appraisers, a faculty member of the American Institute of Certified Public Accountants, teaches degree accredited courses in accounting and finance at university level, and has testified as a business valuation expert in multiple venues. He's an active, this is definitely true, member of the board of directors of the New England Business Brokers Association, and he's a member of the board of governors, course developer, instructor, and lead subject matter expert for the IBBA, the International Business Brokers Association. And Lou, we appreciate everything you do for doing this presentation today and all your help and support of NEBBA. Thank you very much, and I'll let you take it from there.
Thank you, Peter. So I want to talk here a little bit. This is more about me. I'm just trying to make sure that I have, all right. The thing I'm missing on my screen is I don't have the ability to, change my screen sharing. No,
What can't you do, Lou?
I'm looking for where I will be able to select different screens. I have one screen up here now, but that's,
You can't scroll forward?
oh, here it is. I found it. Nope.
Okay.
The control bar separated itself from the matrix of everybody's faces and popped over to another place. That's always interesting. All right, so sorry for the delay here, but yeah, I've been doing this for quite some time, from starting in corporate mergers and acquisitions, about 10 years of that, 12 years in that, and 10 years of that was international. And then going out on my own as business broker for a while, and then getting interested in the formal valuation work. As of now, probably about 40% of my work is doing formal valuations for gift and estate tax purposes, but that also includes people that are selling into family members, fractional ownership interests, partners buying in and out as well. I also do about 40% of my work is dispute resolution. Includes divorce cases, includes partners that aren't getting along anymore, partners buying in, partners buying out, things of that nature. So a lot of my work is subject to being beat up by a lot of people that wanted a different number. Probably not different than what you go through. Another 20% of my work includes things for granting of stock as compensation. For example, I recently did a large DSO, a dental service organization that was rolling up dental practices and issuing stock as bonuses in order to attract new C-level management. It was very, very interesting. And I also do work for people that are looking to go to market. There's a handful of brokers out there that come to me on a regular basis because they want a third-party valuation for their client in preparing for that go-to-market. Anyhow, enough about me. I like what I do, I guess, is the important thing. And Peter asked me to talk about today the ValueSource transaction database and an example of how it might be used for pricing businesses. So we're going to go over some of the basic concepts in value and pricing. We're going to look at the analysis of, we're going to review and analysis the ValueSource market comps database, what information's included, what are some of the issues in the data, what are some of the errors I see on a regular basis, and then how we use it to price a small business. We'll talk a little bit about current times as well, and I'm going to ultimately go through this and do it the way the IBBA originally teaches. And that's sort of in a pre-COVID environment, but then also look at how we might resolve some of the issues using this in the COVID environment. So basic concepts that we need to get through. Once again, I tell this everybody time and time again, value is an opinion. It's not calculated. It's based on consideration of the relevant facts, informed judgment, reasonableness, and common sense. A lot of people treat it as a calculation. It's not a calculation. There are far too many variables between the data and the subject company in order for this to be a simple calculation. Ultimately, the valuation theory is very simple. Value is a function, or what are the expected future earnings that are going to flow to the owner relative to the risk that those earnings may not materialize. Earnings we're looking at here, we're going to look at things like seller's discretionary earnings. We're going to look at the revenue of the company. And then the risk comes from the market data. The market data, those multiples, whether it's a percentage of revenue, in some businesses a multiple of revenue, or a multiple of earnings, that's really the measure of risk. Those multiples indicate how much people are willing to pay for $1 of earnings or $1 of revenue. three general approaches to valuation: the income approach, the market approach, and the asset approach. What we're going to be looking at here is one of the methods used in a market approach. In most valuation work, multiple approaches are used. One of the things that came out at the beginning of the COVID analysis was many of the nationally published and national lecturing appraisal thought leaders all came out and said, you can't use the market approach anymore, not because of COVID. Well, their solution is that everybody should do a discounted cash flow analysis, which means you need to project anywhere from 3 to 5, 7, 10 years worth of financial statements. You need to project the income statement. You need to project the balance sheet. You need to calculate what the actual cash flow available to the providers of capital are. And then you need to build up a discount rate from publicly traded information generally and do that analysis. And that's really beyond the scope of most Main Street type brokers. I believe, and in all my valuation work, and yes, I do discounted cash flow analysis, almost every valuation I do, I still do a discounted cash flow analysis, but I back it up with a market approach using the market transaction data. Asset approach tends to be more relevant for either gone out of business and it's a liquidation, or for things like real estate holding companies where it's all about the real estate, it's all about the asset, not so much about revenue and earnings. I also wanted to touch a little bit about it. This whole methodology that IBBA preaches is intended for you to develop a broker's opinion of value. Broker's opinion of value is a very limited type of appraisal of a business. It generally doesn't consider all of the factors that goes into a formal business appraisal. Nevertheless, I've seen more and more in the last 2 years, business brokers going out and using this methodology and applying it to divorce cases, applying it to shareholder disputes, applying it to tax filings, where they've made errors like things misunderstanding the difference between the most probable selling price of the assets intended for sale and the stock, the equity in the stock of the company. So please, one of the important things is if you're interested in formal business valuation for tax, for dispute resolution, purposes like that, then get the training and learn how to do that. But this really isn't appropriate for that purpose. Value of what? That's what I always ask. Whenever anybody says, well, I sold my business for X number of dollars. Well, was that the most probable selling price? Was that the assets intended for sale in a typical asset-based sale? What was included? Was accounts receivable included or was it not? Was it a stock transaction? And there are businesses that get sold as stock transactions, although they tend to be slightly larger. There are some businesses that really require it. For example, I did a company about 2 years ago, and it definitely was a stock transaction being sold out, but it had to be. And the reason it had to be is because this business was involved in chemicals that had been approved by the EPA. And the EPA certificates belong to the corporation. So in order to transfer those certificates and all those approvals, which is a long, difficult process, the stock had to be sold. Nevertheless, by the time they were done with that, it still looked like an asset-based sale. The stock transferred, but they had cleared out all the cash, they'd cleared out the accounts receivable, and they had paid off all the debt. So it still looked like an asset-based sale. It wasn't what was the value of the stock as an operating company. Sometimes people need to know total assets. Sometimes people need to know personal goodwill. We're going to focus primarily on this most probable selling price, which is what we're looking for. And that, the assets intended for sale, that represents the total consideration established between a buyer and seller. Parties can be compelled, either the buyer or the seller. There's potential financial, strategic, and non-financial benefits to the seller and probable buyers. This is different than the traditional definition of fair market value. Fair market value says the parties are not compelled. It's an all-cash transaction, and it doesn't include financial, strategic, or non-financial benefits to the seller and buyers. Anyhow, our most probable selling price usually is the market value of the tangible assets, the intangible assets, the goodwill, plus or minus any adjustments that get made. This is basically how small businesses get priced to go to market. The direct market data method is a method that the International Business Brokers Association has developed for its training courses primarily. And it's a market approach. It uses transaction data from companies that have actually been sold, private businesses, to estimate this most probable selling price. So the whole idea here is that this is most applicable to small business sales. You know, if you're looking for what a business might sell for, one of the things that is important is, well, what did other businesses in the same category sell for? That was the market. Concept here is about as simple as it gets. One of the things we need to consider now, in sort of expanding this to the world of COVID, you know, you gotta look at the situation of the business. I see a lot of people, they simply calculate the numbers, they look at the data and they apply it. But when you get through, and we're going to talk about why you need to look at the data. But one of the real issues here is that what is the state of the business? And businesses out there today fall into at least 5 categories, but these are the first assessment. Is the business wounded and it's going to die? Then this probably isn't the method that you want to use. Maybe you're looking at a liquidation. I know in some markets, I think it was one of the folks from Las Vegas was saying that they changed the direction of their brokerage to liquidations because Las Vegas was just absolutely devastated by this COVID pandemic. All small businesses were pretty much hit. Businesses I see out there, some of them are wounded, but they're going to recover. Some of them are very marginally ruined. They're down a little bit, but they're still profitable. Others are wounded more dearly and they weren't able to react quickly enough to the fall off in revenue, and they show negative profitability, net losses. I see businesses out there that are somewhat unaffected by this. There are businesses out there that are thriving temporarily. Certainly, I know other people have probably seen as well. The construction trades, general contractors, plumbers, electricians, carpenters, the people that supply the dumpsters. Those businesses are all booming. What do you think about the people that make all the boxes that Amazon's using to ship everything? Can't tell you. It's like every week I've got this huge, it's almost as the pile of cardboard boxes in my garage is almost as big as the car every week. Because I got a number of extra people living with me that moved back in. So just for Jennifer and Aaron, they grow up, they do go away, but they can come back. And they bring others with them when they do. Anyhow, there are also businesses out there that have turned this into an opportunity to expand their market presence. Perhaps a competitor has gone out of business and they've been able to gain market share, and they expect to keep that market share gain going forward. So every one of these is a different case and it has to be considered. This is more important than some of the other things people look at. This can be industry-wide as well. Some of it, obviously, restaurants in general are hurt, although I have seen some restaurants that actually did better. Businesses that were already primarily focused on takeout or a walk-up window, particularly seasonal ones that were open and had a lot of outdoor seating, kind of place you walk up and you buy your clams at the window and then you go sit on picnic tables under the tree, plenty of parking. Some of those actually did better than they had ever done because last April and May, that was the only thing that was in town that was available to go out and eat to. So you need to really consider the situation. And this brings me back to one of the points that's really important as well. Goes back to, it's an opinion. we're really storytellers. And even the formal valuation community is more and more come around to saying that it's more about the story, it's about qualitative factors, it's not just simple calculations. And that's not new. When I first started in this, I met a fellow, actually, back in around 2002, I think it was 2001, I came to my first NEBBA meeting and was interested in this, and I met some people. One of the people I met was Warren Burkhalter. And I don't know if you all folks remember him. He retired about 5-6 years ago now, moved out to the West Coast. But he was one of the main people around here in NEBBA. And he told me in the very beginning, he says, it's not about the numbers, it's about the story. It's about what's going on, what's the opportunity. More so than, obviously numbers have to support something, but it's really about that. So we're storytellers. So let's talk about the ValueSource market comps. There's numerous databases out there people use. ValueSource market comps is generally the one, I believe it's still included with your IBBA membership for free. It's probably the oldest, it's the biggest, and it's the one that the IBBA uses in its training courses now. There's also BizComps out there, Deal Stats, used to be Pratt Stats. There's also peer comps, there's others. There's other sources of market data. Today, we're going to talk about primarily the ValueSource market comps. So there's general characteristics of all of these databases. These databases all contain small, mid-sized, privately held companies that have actually been sold. The data is reported by accountants, attorneys, business brokers, and other parties that have been advisors to the actual sale. But one of the things that's generally been accepted is the median multiples for small business transactions don't appear to exhibit a significant change with time. Now that can be industry specific. Certainly some of the data like the ValueSource data goes back to the 1970s. So, you know, do you think VCR repair is still a great business? Well, or how about VCR rental? Well, I remember when I was in grad school in the 80s, these were boom businesses and they were being sold, and so it was a lot. So yeah, it's not true. You need to look at each particular industry and you maybe want to do that analysis, but the analysis that's been done by the databases overall finds that the price to revenue, the price to earnings generally doesn't change with the economic conditions the same way that public market and M&A market data do. Again, there may be industries that doesn't apply. More of the difference in value in businesses housed in changing economic times has to do with the changes in the revenue and the changes in the earning more so than the determination of risk. Now, this data started being collected back in the 1980s. Ray Miles founded the Institute of Business Appraisers, and you know, over the past 40 years, there's just been significant analysis and a lot of so-called conventional wisdom about the data. There's only a few industries that show a regional bias. The bias may be temporary in nature. No region of the country has generally higher ratios than other parts of the country. Nevertheless, there's some specialized businesses that you may see differences. One of those people always used to say was liquor stores in states like Massachusetts, New Jersey, and Florida, where those licenses are very, very heavily controlled. Does someone have a question? We're getting feedback. Yeah, there we go. Nevertheless, so people say, yeah, but well, so liquor stores, certain states that heavily restrict licenses, they may sell for more. I would always heard that. I've done a lot of liquor store evaluations. I pulled a lot of the data, and it's actually hard to support that by looking at the data. So sometimes conventional wisdom is not always true. Arguments like, well, what about a pool company in Florida? Wouldn't that be worth a lot more? So will a company be worth more, but it's not because the risk is necessarily different. It's rather that they've got a longer season. They have higher revenue and overall higher earnings altogether. Maybe. I haven't actually done that analysis. So you want to, again, use some common sense, informed judgment, collect the evidence. Some industries are significantly higher or lower ratios than others, shown by the all industries overall. This is the most important factor. Industry has a lot to do with it. The other thing is size has a lot to do with it. That's where the data value varies the most. So whenever you see these things like overall in the last quarter, deal stats, overall the price to EBITDA increased. Those kind of statements are just meaningless. All right, value comps maintained by ValueSource. Used to be by the IBA, the Institute of Business Appraisers. They bought it. Ray Miles started in 1978. There's 48,205 transactions as of yesterday. 10,729 of those are from the last 10 years. 80% are under $1 million. You can filter in a variety of different ways. So a lot of data there. They've got some tools. They're easy to use. Unfortunately, I strongly recommend you do not use their data analysis tools because there's a lot of flaws in the data that need to be cleaned up. And I think you can get false indications. DE was defined differently until more recently. And there's a long story about that. And well, the reported consideration is also the way we define price. We'll leave it at that for now. I'm going to get into this issue of what how the DE is defined. It used to be EBIT and owner comp. And that was primarily because at the time, Ray Miles was dealing with companies where depreciation was not a significant expense for the types of businesses. And at one point I called him back in, I don't know, about 7 or 8 years ago to ask him about this because somebody challenged me on it. And he told me, he says, well, you know, I know what I asked for. I asked for EBIT plus owner compensation, but I don't know what people actually sent me. So look at the data. There are some, if your industry or subject company where depreciation is a significant expense for that business, then maybe you should be defining the discretionary earnings the way the IBBA does as EBITDA plus compensation. If depreciation is relatively insignificant, maybe not. You have to make a judgment. Again, collect the information and use your experience. None of this is perfect. Data issues, what was asked versus what was received. They talk about that, the definition of sells discretionary earnings, and the data was not verified. Those are all, you know, it's not like valuing real estate where you can go to the registry of deeds and collect the data about what was actually done. So common errors or definition of earnings, what's included in the price. We don't really know. We think we know. He said, I asked for this, but I don't know what people did. Transaction size alignment with the subject. Often see people using transactions that are way too big or way too small because size matters. That's one of the most important. Size and industry are the two most important things. I've also seen people use the wrong industry. Using the mean, averages skew the indication or the central tendency towards one direction, generally towards the higher side. Using canned software applications that are on these websites and a calculation approach rather than opinion based on judgment. I'm not going to go into the statistics on this. I'm just going to go through quick history. This direct market data method, 1970s, business brokers basically said, Companies are worth 2.3 times discretionary earnings. Trust me, I'm a business broker. I know what I'm talking about. There was no data. There was nothing to back it up. So Ray Miles started collecting data. He really started in the 70s. And in 1984, he published the Basic Business Appraisal that introduced this market data approach. In the mid-90s, he did extensive analysis on the database that's been repeated and repeated over and again. And in 1998, they renamed this the direct market data method. The IBBA picked this up, and that's what they use and apply as well. So the IBBA says there's 7-step process in normal times. Parameters for the subject, collect the transaction data, evaluate the data, remove the outliers, calculate your indications of value, adjust the values, reconcile the values, and report your conclusion. We're going to go through those. We're going to do a case study here to illustrate how this works. What do we need? The data we need basically in order to apply this is we need the revenue for the company. We need the discretionary earnings for the company, so you have to have done your recasting. We need to know the industry SIC code. One of the shortcomings of the IBA data, which is now the ValueSource data, is it only has the data by SIC code. It does not have it by the NAICS code. So sometimes the SIC classifications, which are from the mid-1980s, are not as relevant today. Some of them are quite broad and include industry information, industries that may not seem to be closely related or businesses. So that's something, one of the downfalls we also want to watch for is our subject company aligned with the definition of the industry we're using in the data. Couple indicators of central tendency. One is the mean, that's the arithmetic average. As I've said, that's often skewed one direction. The median is the midpoint in any set of data. It's the middle value. It's usually the best indication of central tendency. It's a one Ray Miles really was very strong about using. Certainly because the data tends to be skewed. There's data points that are for some larger companies, and that will just pull the average, the mean, up on higher than it should be. We'll take a look at that. A lot of talk out there about using a harmonic mean, and you know, Toby Tatum has published articles, and he and Mark Filler love to have the dueling articles. If you ever have seen this, I assume some other people have seen these dueling articles where they write, you know, 3-4 page articles about statistically why their method of calculating value is better, when at the end of the day, it's an opinion. It's based on consideration of relevant facts, informed judgment, and reasonableness. The harmonic mean may technically be better. Good luck explaining that to your seller and buyer prospects. You can use a scale. What Ray Miles said is the best way to do this is lay the data out in a scale. And see, where does this business fit in the scale? Is this nicer than a business on average? So it should be in the top half of the data. Is it uglier than businesses in general in the industry category? It should be in the lower half. And he said, you look at this scale like this and you decide. It's on you. It's your opinion. You pick. It's not a calculation. You pick what you believe is the right multiple. And then you support it. You tell your story about why this business is better than the typical business, why it's in the top half. There's a lot of people that want to even take the math further and use regression equations. I don't think it's really, you know, using regression equations on data that may be bad to begin with. I don't see that as the best thing for business brokers to be doing. When it comes to the weighting and reconciliation, we want to continue both the quantitative factors, the history of the business. Has it been around for a while? Has it been doing well for a while? Has it gone through a downturn? What's its growth look like? You need to get enough data for enough years that you can actually see what the real growth has been like. What about the age and condition of assets? One business otherwise, two businesses otherwise identical. One of them has vehicles that are on their last leg and will need to be replaced soon, versus another business that otherwise looks the same, but the vehicles are contemporary, they're in good condition, they're beautifully bannered, they're basically driving billboards for the company. Would one of those businesses draw a higher price than the other one? That's not going to be reflected in these calculations. That's something that you need to help decide. Is this business worth more than the median or less? Qualitative factors. How about the quality of the financial information? Now, some of these small businesses, it's absolutely horrible. Some of them, it's pretty good. Some of them actually have an outside bookkeeper that keeps the books in at least a reasonable fashion. What about location? That might make a difference, whereas different parts of the country may not be as important, but location within a given town, that could be important. Location within a given geography relative to the market they're serving, that could be important. What's the cost of that location as well? Do they have favorable lease? Do they have a long-term lease that's transferable with no increases for the next 5 years? Or do they have a lease that's going to increase by 10% next year? Those can all make a difference. So you can't just look at the straight math. These other factors are much more important in many cases. So let's go into a case study here. See if I am able to do this. Okay, we're going to start with what the first thing is that we do. Okay. I'm sorry. Nope, I'm going to stand corrected. So I want to look at this other one first. Oh, this is weird. Why do I not have? Oh. Ah, there we go. Sorry, it was hidden. Yes, I'm software challenged. I hope all of you are not. Okay. Why is this? I don't understand why. I'm screen sharing. Do you see my spreadsheet? You don't see my spreadsheet. Do you see my spreadsheet?
Yes, we see the spreadsheet.
Okay, it's not showing up on my screen. That's why I apologize. So let's just take this and start here. Look at this piece, okay? First thing we need is we need to recast our financial statements. Here I've got, this is actually a cleaning company. This is a real case. Actually, I did this just a couple months ago. And I'm looking at a situation here where it's general, they do both residential and they do commercial cleaning. It's been around for a long time. I've got 6 years worth of data here. I don't know if you also see my cursor on here.
We see it, yes.
Assume you do? Okay.
Yep.
And you can see we had a little bit of a fall off here in 2020. We had about a 14.5, almost 15% decline due to the pandemic. They were slowed down for a while. Some of the offices were closed that they do. Some of the homes had them delay, but then with everybody working at home, they decided they needed cleaners to come back. And then some of the offices said, well, we got people in here, we need to do extra cleaning. So there was a bit of a downturn. But if I look in the past here, if I only was using 2019 data, well, I'd say they're doing over $500,000 a year. It's a 15% decline. But you know, they only did 485 in 2018 and 2018. They did good in 17. They did good. So you need to look at a longer period here. The average is 505, about the same as what they did in 2019. Okay, so what we also then need to do is we need to collect our data. So we've got recasted, as you can see down here, you've got discretionary earnings. I've got, in 2019, we had 509,000 in revenue. We had 137,000 in DE, and that dropped to 435 and 100,000 discretionary earnings down here in 2020. The expectation is from management that they expect to come back up here and do like they had been doing in the past, probably somewhere on average around $500,000 a year. Okay. Next. Next, we need to go to the ValueSource database. We're going to log in. We're going to go to the ValueSource comps data. This right here is the default, is limiting it to the last 10 years. I always like to get all the data because I believe it does not change in time, but it might still be useful. I may end up limiting it in time, but I want to get all the data to begin with. Looking up here, my industry is 7349, building, cleaning, and maintenance services. So I'm going to plug in 7349. Fine, I'm going to search. And there's 817 transactions in that industry category. That's plenty of data to work with. I believe there was about 200 and something of them that were within the last 10 years. You have these options down here. You can get an analysis. You can get a direct market data report. Why do any work when they'll do it for you? Well, I have tried those and looked at those. I strongly recommend that you do not use that. I always download the data. I just get the data like this. It comes up. It offers me this little ValueSource comps. I download it, I save it, and I'm just going to cancel it because I already did that for you. When I download and I open the data, it looks like this. This is what the data looks like when I open it. I get all this good stuff. And it's got a number of different things in here. This is the original, or actually it really only originally had four columns. It got expanded. And then a few years ago, they started collecting more. So you start to see things like more details about the business. And then they started adding balance sheets. And then they added income statements, multiple years of income statements in some cases, and up to 3 years. And then some additional things about asking price, how long it might have been on the market, what was the down payment, things like this, what was the actual sale. But as you can see, the additional data for many of these transactions is very thin. I simply take this section here that's in the gray, I copy it and I paste it into my own spreadsheet because I want to do my own data analysis. So now if I look at this and I'm going to do my own data analysis, right here's the IBA data that I copied in. There's 817 transactions. It's for SIC code 7349. They range from 0 revenue to $23 million in revenue. So the first thing I'm going to do is I'm going to cut this down by size. My company has about $500,000 in revenue. So the first cut I make here is this group, and I pull this down, and I now have eliminated everything that's greater than $250,000 or smaller than $250,000 in revenue and greater than $1 million. So I've got roughly, how do you size it? Well, one of the rules of thumb was half the size to twice the size. And that was something I think Ray Miles had thrown out once. Other people have said 1/5 to 5 times the size. Part of it depends on how much data you have. And I look at this, and one of the things I do is I do have my own analysis built in here, where I can see what the high value is, the low value, the median, the mean, which is the average, the median values, and I can see what also, how these metrics look. So the median values are right here. I also create my own graphs because I want to control them. I want to control how they look, and I use them in any report I do. So in this instance, it looks to me like I still have way too much data. I've got 360 transactions still that are in that size category. And it's, you know, it's so jumbled here. I can see there's a lot of outliers. You know, $1 million really relevant to this business is $800,000-900,000 in discretionary earnings relevant for this business? I think not. So I've also noticed that right here, one of the metrics I've calculated is discretionary earnings to sales. There's a whole bunch of transactions where the reported sales and the reported discretionary earnings are exactly the same, or very close, 99%. How many businesses do you see where the revenue and the discretionary, that means they have no expenses? It's just silly. So I'm going to take all of those out as well, because I think they're not representative, and I don't know which number was right here. I don't know if the DE was right. I don't know if the sales was right, but clearly a business with no expenses doesn't seem right to me. So you need to look at the data. You can't just, all of these would all be included in the analysis that is done by the machine. You need to look at the data. You need to clean it up to some extent. So now in this next sheet, I've cleaned it up a bit. I decided maybe I'm going to cut that down to 350,000 to 700,000, a little bit closer, plus or minus, say, 200,000, 150 to $200,000. A much tighter group. As you can see now, I've got a much better layout here, but there's still, you know, the data is not all on one line. Same with the earnings metrics. It's not all on one line. But I've got some very good statistics here. I've got, again, here's my median and mean. I also calculate the 75th percentile, which is the middle of the top half, and the 25th percentile, which is the middle of the bottom half. I've got some metrics here. I do calculate the harmonic mean because it's always fun to look at and see how it is. I also, important here is the coefficient of variance. That is how tight the data fits the average. It's a measure of how dispersed the data is. Is it tightly grouped? It's probably stronger and better. If it's all over the place, it's probably not as good and reliable. So those are the data. That's what I have. I'll use these charts in my actual reports so that somebody can visually see how the actual data is. It's important for them to understand this doesn't all line up on the line. People need to really understand that. And you need to understand that because you're going to tell people, well, I think your business belongs here, not just on that line. Next, I'm going to now do some calculations with this. The median value that we had over here for the price to revenue is 53%. And it's 2.3 times discretionary earnings. Isn't that wonderful? That's that magic number again, isn't it? Those brokers in the 70s really did know what they were talking about, at least for this industry, for this business. The coefficient of variance, I like to put these here as well because it helps me judge which one of these is better. Now here, I've used, and as you can see, I've got a lot of data points. I still have 180 transactions here. And I like a lot of transactions because someone says, oh, you cherry picked 5 transactions or 3 transactions. No, this is the entire market. When people question your data and say, I got 180 transactions, I've never found that to be at least somewhat compelling. This is a factor. This was the revenue from right here. This is the discretionary earnings from 2020. This is what they did. I've taken the average of those 2 indications here, and this one's really strange if you noticed how close they are. I can indicate $232,000 using revenue, $233 using, and I didn't manipulate the data. Truthfully, I did not manipulate the data. It came out this way. Nevertheless, on average, that's about 232, 233. So I've also calculated, here is the value at the mean, which is if I use the average, you can see instead of 232, it goes up to 260. Here's the median that we used. The 75th percentile brings us up to 313,000. And over here, the 25th percentile brings it down to 166,000 using the COVID year. Is that one reasonable interpretation of the potential range? So this probably falls somewhere between 313,000 and 170,000, maybe. I think you can make a good argument about that. But we all know that COVID, and based on this business, COVID is not truly representative of what's normally been happening. Yes, the business has fluctuated some in the past, but on average, it's been doing about 500,000, much more what 2019 appears to be possibly more representative, at least on the revenue side. Always important to calculate your discretionary earnings as a percentage as well. Did the business become more efficient? Well, clearly on a profitability standpoint, the average is only 108,000 and they did 130, almost 140,000 this one year. So they had an efficiency improvement. One of the things you need to find out, is that something that would be considered permanent? They still were higher even in COVID, but they increased expenses due to protective equipment that had to be done for the employees. So there could be things there that you want to consider. So I reran this using the, so the next thing we do is now I take this, I look at this coefficient of variance, and rather than going with the average here, I'm going to give each of these weightings based on how good I feel these numbers are. And 2 of the factors that I've taken into consideration here are, 1, this coefficient of variance. The price to revenue number is generally much tighter. It's a 42%. Usually the general rule is lower than 50% is better. Higher than 50% is not as good of a match, but it's almost 60% here for the earnings metric. That's important in the data. I take that into consideration. Also, I've got more data. Not all of the transactions had price to earnings ratios. So now I've got this, and I'm including those 2 factors that I have made a decision that I'm going to give this twice the weight of revenue as opposed to the earnings. In addition, I'm also saying, and you know, this was an unusually profitable year, so maybe it could be not as replicable. Again, I make a decision though about that that gives me, ultimately, still gets me back to the 232. And pretty much these numbers are so close, it doesn't matter how I weight it. That would round to about a 230. I haven't made any other adjustment here yet. So that's COVID. Well, what else might I consider? They're going to say, well, COVID may not be fully representative, but it is a fact. And it's a fact that COVID's not over yet. So I also reran the analysis using simply the 2019 numbers, the revenue and the earnings there. Everything else is the same. The weighting's the same. That gives me an indication of value of 290,000. So I would feel comfortable that maybe in 2019, I might have said this would be worth $290,000. Might have been. I might have notched it down a little because it was a banner year, particularly on the earnings side compared to previous years. But the way the IBBA applies this, that's the number that they would get. What's the potential range here? Well, using the 75th percentile using this year, I get $400,000 to $200,000. So is that a reasonable potential range for this business? Starts to help me bracket it. What if one way to represent this is I say, okay, this year is underrepresentative because sales were down 15% over the prior year, but probably only about 10% or so, maybe less than the 15% over the previous year. What if I increase this 10%? Simply, I'd get 260. What if I look at the 2019, which was the banner year, and I say, well, maybe I would adjust that minus 10%. I get 260 again. Can I build a reasonable case that, yeah, there's a reasonable expectation that this might be valued at 260? And then what are the other factors? What other factors would make me want to do this? This particular business happened to have fairly new, none of the vehicles were more than 2 years old. They were beautiful. They were well maintained. They were painted. They had beautiful professionally done signage on each of the vans, phone numbers, a marketing pitch, wherever they drove to a place. They had long-term employees. They had management that was able to go out on site and supervise. The owner stayed in the office for the most part and took phone calls and did the bookkeeping. He actually did the bidding, but they had people out site that were doing the work. All of those factors might push this up a little higher. Maybe I would do this as, 10%. Maybe this would only be minus 5%. 270 to 260. Do I want to price it at 270 and let the market tell me that it's only 260? These are all possibilities. At the end of the day, it's not a simple, straight calculation. That's the point I'm making. We use calculations to understand and look at the data and find what the data is telling us. But at the end of the day, you need to pick a number, and then you need to build the story about why you believe that's the right number. All right, I probably went over my time, but I thought I was actually starting at 11, so I apologize, Peter. I thought I had at least 45 minutes to an hour or more, close to an hour.
Okay, no problem. That was a little misunderstanding, but listen, you went over, but listen, this is recorded, so people are going to be able to, if they couldn't catch the whole thing, they'll be able to get the rest by downloading and watching the video on YouTube.
So you're back here now on my my slide?
I see case study and a single dot.
Yep. So anybody has any questions? I don't have to run away. You're welcome to stay and ask questions. Anybody feels they want to leave, but they get questions for me after. My email is there. My phone number is there. And as folks that have known me for years here, I'm always happy to discuss any valuation issues, any pricing issues with anybody who's part of the NEBBA community at any time. So feel free to reach out to me and talk to me. Did anybody have questions they wanted to?
Yeah, there's two here, I see. We got Alan Zinzer asks, "Hi Lou, have you seen general suppression of earnings multiples for small businesses, and in parentheses under 5 million in revenue, due to disruption of internet or maybe globalization? I am talking about businesses that 5 or 10 years ago sold for 3x earnings, now sell for 1.5 to 2 times earnings. Disruption based on disruption of the internet or globalization. In other words, they're getting competition maybe more from outside the country and things of that nature, or across the country."
No. And again, as I said, very much industry specific it can be. It can also be very specific to the business. You know, one of the classic things that I really stood out to me. So years ago, everybody was saying machine shops were dying. They're all, you know, China's beating them up, or Mexico, all these other places. They're not making any money. And a lot of them were being sold in liquidation to get rid of the equipment. And when I was out there, I found more than a handful of machine shops that were absolutely going under, because they were still trying to do things the old way and bang out as many undistinguished, low quality parts as quick as they can. And I then saw a handful of people that came to me as clients that had pivoted slightly, and they had gone into prototyping. They were doing short runs of highly quality, high stringent requirement pieces. And they were high value pieces. So nobody was going to send those to China. Nobody wanted to send those to Mexico, and they were thriving and growing. So it goes back to each and every business. What is their specific? I have another story. There was a convenience store in the town that I live in. I live in New Hampshire. I live in a small town. And back then, the nearest grocery store, the Market Basket, was 20 minutes away. So this convenience store was a broad convenience store, and a lot of people used it because they didn't want to drive all the way to the grocery store. So it was booming. And this guy wanted to sell it, and he showed me how well he is and all that. And then I started doing a little research and found out that Shaw's had filed to put a store in behind them.
I think
what was
you knew
gonna
that
happen?
when you asked you, but go ahead.
So yeah, and when it did, that business went down. And so the guy wasn't going to sell, because I told him, no, you're crazy. Shaw's is going in behind you. And then he didn't sell. He kept it. It went down. Somebody else finally bought it and pivoted and turned it into more of a deli, more takeout. It happened to be next to the most popular daycare center for kids in the town. And I knew my kids went there, and I always stopped and went into that convenience store to get them something to eat when I was picking them up at 6 o'clock, because they were ready to climb the walls. So it's those things I tend to be specific to both industries as well as to specific companies in industries.
Lou, a different question. If you had a family business that owned real estate, and they wanted to, two siblings wanted to separate their assets and not own them jointly anymore, could you do the evaluation for the two of these siblings in who wanted to separate their assets from one another? Maybe keeping some of them, but could you help do the valuation and for both of them at the same time? Or would that be a conflict of interest?
Yes and no. No, it depends. Even in divorce cases, not unusual that I get hired jointly by both parties. The same with shareholder disputes.
Okay.
Nevertheless, I'm not a real estate appraiser.
Okay.
So I would still need to have a real estate appraiser appraise the real estate, and then I would be able to value the business based on the real estate appraisal and applying what's a reasonable market rent for use of the
Thank you.
property.
Okay.
Someone had their hand raised. I saw there was a hand raised, but
Yeah, I just wanted to ask you a question, Lou. On your valuation, you looked at the 2020 and you looked at 2019. Do you give any weight to year to date, like the first month of this year versus first month of last year, just to kind of understand where the business is going post-pandemic? Is there any weight to that on your valuation?
clearly in deciding to go back and use 2019, yeah, so in my actual work, I always build a forecast. And that includes a conversation with management and whether or not I believe a reasonable expectation that the business is going to come back. Again, is it wounded and it will recover? Will it recover fully? So it is important to consider where it is now. If I'm looking at the end of the quarter, March, often with small businesses, the quarterly financial statements are much worse than the annual ones where, you know, the CPA or the tax preparer has at least gone through and cleaned out a lot of the personal expense things. So I guess it would be a good indication. But yeah, it's important to understand whether or not this business is going to come back. I'm using 2019 because I believed that this business will come back to where it was, you know, on average 19, 18, 17, 16, 15. It'll get back there. It may take a little bit longer. It may take mid-year to maybe even all of 2021. Each business is again very different. This COVID thing's lasted longer than we expected.
Lou,
What are
we
you
have
folks doing?
Lou, we got a question from Phil Steckler, who I think has left us, but he still wanted me to ask the question. He's talking about discounted cash flow, and he says, yes, discounted cash flow is a recognized method for valuation. However, in the past 10 years or so, there have been two significant economic challenges: the housing crisis and the pandemic. Using this method prior to these events would not work particularly well, as many companies stopped growing and opinions based on growth overvalued the business. How would you protect yourself and your client from this? So I guess I guess he's talking about the unpredictability of the future and predicting growth.
Yeah. Again, you have to look at each specific business. All of these methods. So the most important thing to understand here is baked into these numbers is a buyer's expectation of what's going to happen next year. Into all that data.
Mm-hmm.
All that data in the IBA has baked into it what the seller thinks the business is going to do next year, because that's what he's selling. He's not selling what it did last year. He's giving up the earnings that he would be earning next year. That's in there. The buyer, the multiple they're willing to pay, also has baked into it what he expects to happen next year. So growth is already baked into these. Second, in businesses, specific situations where there is no growth or the growth is expected to be negative, that's built into the forecast that is then used in the discounted cash flow analysis. I'll give you an example. Well, so it's kind of like a mining company where it buys the mountain, it clears the mountain, it takes the coal out of the mountain, but then at the end, when the coal's gone, it's got to put the mountain back. So instead of having a terminal value or a sale at the end, it's got a cost. I did a business 2 years ago that was primarily involved in trucking, and their drivers were all Teamsters. And there's a huge problem that the Teamster Fund in New England is grossly underfunded. But the contract with the Teamsters is that if the business is sold, the owner of the business has to make good on what's missing they have to fully fund the Teamsters pension fund. So the businesses are unsellable. Nevertheless, holding the business and keeping it for the next 5 years has value because it was throwing off a lot of money. But at the end of those 5 years, it won't be sellable. And what these trucking companies have been doing in New England is that's exactly, they keep them for a number of years. And when they decide they're really done, they declare bankruptcy and they shut it down. They suck all the money out before they do that. So discounted cash flow is ideal because it requires you to look at the specific situations of the business, understand what are the drivers of that business and what its future really looks like.
Okay, good. All right, so, all right, I think we probably should end right now because it's 12:30. And like you said, though, Lou, anybody that has any follow-up questions could send them to you directly. And I just want to say thank you so much for doing this. You've really helped New England business brokers yet again, and we appreciate it. You're a hero of NEBBA and have been so for many, many years. And I just want to remind everyone, don't forget our next meeting is May 12th at 11 a.m. And I am determined to get this video up on YouTube right away because I know people that couldn't hear the whole meeting or weren't able to make it want to see your remarks here. So it's really terrific. Thank you very much, Lou.
Peter, I have one more quick thing. Thank you very much. I appreciate all that. Nevertheless, I do want you, this is simply an illustration of one way to look at this. It is not the gospel. It is not the only way. But I hope I impressed upon you the important point is not to do simple calculations and clearly don't use the software that they've got on these websites.
Okay.
Stay well, everybody.
Thank you, Lou.